At Know Your Numbers Accounting, we believe in providing free small business education. We can't give you an official degree, but we can offer an emphatic thumbs up after you watch this video. Today, we'll be talking about equity ratio. The equity ratio is one of the few significant leverage ratios. If you don't know what those are, go back and watch our video explaining leverage ratios. It involves Yetis and lemonade, and no, we probably didn't write it while playing Mad Libs. Right. The equity ratio measures the use of equity to finance your business. The formula looks like this. Your equity ratio equals total equity divided by total assets. Both equity and assets are found on your company's balance sheet, which sort of sounds like a toilet paper brand, but definitely isn't. The total equity portion of this formula is the balance remaining after liabilities have been subtracted from total assets. Total assets are, well, you know what total assets are. They're all the stuff, money, and resources your company owns. So when you divide those two, you get a ratio that tells you exactly how much of your company's assets were paid for with equity. Let's dive into an example. Say Business X sells those giant blow-up character balloons for a parade on a river. Cartoon Balloon Platoon Company X checks their balance sheet. They have total equity of $500,000 and total assets of $1 million. Divide the two, and you get an equity ratio of 0.5, meaning half of the company's assets were paid for with equity. The lower the equity ratio, the greater the reliance on debt to finance the business. More debt equals more financial risk. It's kind of like a circus clown riding a unicycle. Now, the smaller the unicycle, the more teetery that clown becomes. Generally, a ratio below 0.5 is considered leveraged, and a ratio above 0.5 is considered more conservative. It's tricky though, because a low equity ratio isn't necessarily a bad thing for investors. If the company is profitable, it's giving those cartoon balloon platoon loons a pretty great return on investment. But that's a big if, because if the equity ratio is low and the business is not profitable, reliance on debt can mean that interest expenses multiply, and debt may sink that inflatable porky pig right into the river. That's the definition of not bringing home the bacon. This is why financial institutions like to see a higher equity ratio when they distribute loans. More equity than debt implies a more stable business that looks much less likely to default on borrowed money. If leverage ratios make your head feel as swollen as giant float balloons, contact Know Your Numbers Accounting today for speedy, expert advice.